Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Petrobras' stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Petrobras operates in three business areas. The first is exploration and production, the second is refining, transportation, and marketing, and the third is gas and power. It controls significant oil and energy assets all over the world. Although Brazil is a majority of its production, it provides most of the oil and gas in Brazil. It has a large amount of reserves, mostly located in Brazil, in order to optimize its infrastructure and limit costs of exploration, development, and production. It has developed technical knowledge in deep water exploration and production from almost 50 years of working in Brazil's offshore basins. It does go beyond oil and gas exploration and production. It transports oil and gas to its refineries and gas treatment units in order to supply the best products. It is also involved in the production of petrochemicals through subsidiaries. It distributes oil products through wholesalers and retailers. It is also involved in the Brazilian natural gas market. It is trying to get heavily involved in renewable energy. The company is headquartered in Rio de Janeiro, Brazil, and was founded in 1953. It trades on the New York Stock Exchange, Deutsche Börse, Mexican Bolsa, Sao Paulo, Buenos Aires, Spanish Bolsa, and London Stock Exchange. Let's get started with the model. This is a large cap company, 63 billion market cap. They're trading at $9.72 a share, and they have 6.5 billion shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So look at all the free cash flow. 14 billion way up to 29 billion. That's a ton of free cash flow. That's the cash that's remaining for you, the investor. Net income is the profit or loss of the income statement. It's revenue minus expenses. And that peaked in the trailing 12 months at close to 26 billion. Revenue is the sales for the company, and that was 96 billion in 2018. It did drop in the trailing 12 months to 74 billion, but it is up a lot from 2020. This is the company's income statement. The top line is the revenue, the sales. Here's a breakdown of their 2019 and 2020 revenue. You can see they produced more products in 2020, slightly more than 2019, but their revenue was down a lot because the price of oil really crashed in 2020. Look how much lower the prices were per barrel when compared to 2019. They sell more diesel than anything else. Then second is automotive gasoline. Diesel is more efficient than gas. In the US, gas is much more popular than diesel, although most trucks and buses in the US use diesel. Although in Brazil it does appear diesel is more popular than regular gas. They generated 1.7 billion of sales from naphtha. Naphtha is used in things like solvents for paint, also solvents for the rubber industry. 3.4 billion from liquefied petroleum gas, 1.5 billion from jet fuel, 3.6 billion from natural gas, and 2.4 billion from electricity. About 1/3 of their revenue is from exports. They do export some products to countries that border Brazil, but they do have operations in a lot of countries. So it would be crazy to export oil from Brazil to Africa or Asia. You could do it by boat, but it's much easier to set up operations in those countries and sell it directly there. Below revenue is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that was the highest in the trailing 12 months. Below that is their operating expenses, then their operating income, which was also higher in the trailing 12 months. They had lower revenue when compared to 2019 and a lot lower than 2018. So it looks like they cut a lot of expenses and are becoming a lot more efficient, bringing in more operating income with a lot less revenue. They spent 5.2 billion of interest on their debt, and the bottom line of the income statement is their net income, which was their highest ever in the trailing 12 months. But their net income was a little inflated in the trailing 12 months because of this $11 billion gain. In 2020, they passed through a $12 billion loss. That's why their net income was so low that year. When you invest in a company with a lot of fixed assets, they pass through lots of gains and losses that can really skew the net income. So I would just focus on operating income when I look at the income statement. That's a better indicator of how the company's doing. But you should try to understand everything on the income statement if possible. This is the company's income statement from their annual report. So this will provide us a little more detail than Yahoo Finance because sometimes Yahoo Finance consolidates the data. This only shows us 2019 and 2020. The top line is the revenue, then cost of revenue, then gross profit. They have $5 billion of selling expenses. This is the cost of the materials, the cost to transport the products. Also, depreciation and some payroll costs are part of this. Then below that is G&A expenses. This is payroll, rent, and depreciation. They had an exploration cost of $800 million. These are the expenses involved in locating potential sites for the company to drill or extract oil and gas. Then you have $355 million of research and development. And this is what brought down their net income so much in 2020, a little bit in 2019, these large asset impairments. This is pretty common with a company that has so much fixed assets. The company is depreciating the assets over their useful life, but sometimes the value of the asset decreases more than the depreciation. For instance, if there's damage to the asset, or if the value of the asset in the open market drops a lot. They also report equity investments. So when a company has significant influence over another company, usually that happens when you own 20% to 50% of another company's stock. Then you have to report their earnings onto your income statement. So to give you an example, in 2019, they passed through a $153 million gain onto their income statement. So say they own 50% of a Peruvian oil and gas company. Peru is right next to Brazil. In 2019, that company reported a $306 million profit. Since they owned 50% of that company, they have to report a $153 million gain onto their income statement. If that Peruvian company reports a loss, they have to report a loss onto their income statement, as they did in 2020. But this is a non-cash item. They're just reporting what the company's net income is. Net income is not cash. So this gets reversed out on the statement of cash flows. So when we look at the statement of cash flows later, you'll see a positive $659 million to reverse out this negative. The company reports negative $226 million of income before taxes, but they pass through a tax credit of $1.2 billion. So they have almost $1 billion in net income in 2020, $10 billion in 2019. They would have had a big gain if it wasn't for this large asset impairment. They break apart their net income from continuing operations and discontinued operations. $7.8 billion of their income was from continuing operations, $2.6 billion was from discontinued operations. So if there was a part of the company's operation they spun off or shut down, they still have to report the company's profits or losses that occurred for that discontinued part of the business. So in the future, that division won't show up on their income statement. So if you looked at a company's income statement and they had a $10 billion gain, but only $1 billion was from continuing operation and $9 billion was from discontinued operations, maybe they spun off another division into its own company. You would question the future of the company you're investing in because if most of the profits from that company are now spun off into another entity, that probably wouldn't make you feel too good about your investment. But that's not the case with them. A majority of their profits are in the continuing operation, not the discontinued. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. So in 2020, even though they reported a $1 billion gain, they actually generated $29 billion of cash flow because that asset impairment gets added back. We're going to look at the detail from the cash flow from operations section in a little bit so you can see what I mean. So they generate a ton of cash flow, $36 billion in the trailing 12 months, the most ever. And they do spend a good amount of CapEx, $6 billion up to $24 billion, because they're always investing in infrastructure, the pipelines, the drilling platforms, the refineries, the terminals, the processing plants, and the storage facilities. Those are all really expensive items. Operating cash flow minus CapEx gives you your free cash flow, and they have a lot of free cash flow remaining. 2019 was their smallest year on free cash flow at $1.7 billion. They do pay a really nice dividend, but they also pay down a ton of debt each year, a lot more than they issue. And that's helping you, the shareholder, because when a company pays down debt, that lowers their interest payments, it lowers their expenses, which means more money flows to the bottom line for you, the investor. This is the company's cash flow from operations section from their annual report. This is their 2020 numbers. And to calculate cash flow from operations, you start with net income, that was $948 million. Then we have to add or subtract the non-cash items. Remember that loss they passed through of $659 million? Their equity investments in another company? We have to add that back on the statement of cash flows. We also added back $11 billion of depreciation. They have a lot of assets on their balance sheet, so they're always passing through lots of depreciation charges. And the $7 billion asset impairment, that's added back. And something we didn't look at, but they had $11 billion of foreign exchange charges. You also have to adjust for changes in working capital. So even though they reported a $1 billion gain, they actually generated $29 billion of cash flow. So that's why I like to look at the statement of cash flows. This top part is the cash flow from investing section, and the very top of the CFI section is their CapEx, $5.9 billion. They also spent $942 million in investments, and they generated $2 billion from divesting part of their business. And this bottom part is the cash flow from financing section. So they added $17 billion of debt, so that's a cash inflow, but they paid down $26 billion of principal debt, $3 billion of interest debt, and they also repaid $6 billion of a lease. They paid $1.4 billion in dividend payments in 2020, but they raised their dividend a lot in 2021 since they're bringing in so much more cash flow. So they're paying a lot more in dividends in 2021 than they did last year in 2020. Let's look at the capital structure. They have $68 billion of equity, $60 billion of debt. They're 53% equity, 47% debt. Their net debt is $48 billion. And the highest WACC, according to Simply Wall Street, is 14.48%. The higher the WACC, the more conservative the model is. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $130 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $122 billion. We divide that by 6.5 billion shares. And we get a calculated stock price of $19. They're trading at $10, so they're trading at a 48% discount. It's a strong buy according to the model. The average analyst projects their revenue to decrease 2.6%. To get their future revenue, I decreased it 2.6% for the next 4 years. Although I don't think it will decrease for the next 4 years. But just to be on the safe side and not overvalue the company, I did a decrease each year. To calculate their future free cash flows, I needed to see what percent of their revenue they convert to free cash flow. I summed up these 4 free cash flow numbers divided by these 4 revenue numbers, and that comes out to 23%. So I multiplied their future revenue estimates by 23%. That's how I got their future free cash flows. And I'm still coming out with a stock price a lot higher than they're trading at. And I used a really high WACC, a really high discount rate. That just shows you how undervalued some companies are that don't operate in the US. If this was a US company with the same cash flows, their market cap would probably be $200, $300 billion. But since they're in Brazil, a developing country, not as many people buy the stock. Simply Wall Street values the company at $16. They're saying it's 38% undervalued. 3 analysts priced this stock. The average price target was 14, the low was 12, the high was 16. Here's the price chart of PBR the last 2 years. Almost all oil and gas stocks dropped a lot in March and April when oil crashed. It was negative at one point. When the stock crashes for a profitable company, it tends to come back up, as this did. It's still trading about 50% of its pre-March highs, but it has come up since the bottom. This bottom chart is BP, one of the company's competitors. So you can see the prices for both companies moves fairly similar. Not identical, but it's really similar. So as you can see, there's not much mystery to understand why an oil and gas stock price increases or decreases. If oil goes up, the stock goes up. If oil goes down, the stock goes down. It's that simple. Now, to figure out when oil will go up or when it goes down, that's the hard part. They pay a semi-annual dividend, and they raise their dividend a lot, from 9 cents up to 29 cents up to 62 cents. So they pay over 6% in dividends, which is 87% of their net income, 76% of their free cash flow. And they have a beta of 1.39, so the stock is a little more volatile than the market. It's up 19% in the past 52 weeks, while the S&P is up 32%. The 52-week low was 7, the high is 12, and the stock is trading above its 50-day and 200-day moving average. This is a really popular stock. Over 30 million shares are traded each day. Of the 6.5 billion shares outstanding, 4.1 billion are on float. 20% are held by institutions, and less than 1% of the shares are shorted. Their employee count is decreasing. It was about 80,000, now they're down to 49,000, so that is a little concerning. But in the trailing 12 months, they had their most free cash flow ever, so I guess they know what they're doing. If you put $10,000 into this company 10 years ago, you'd have $4,100 today. This would have been a really tough stock to invest in. Pretty much whenever you bought it, unless you caught it at the bottom, you would have lost money. But this could be a great time to pick up the stock. The Brazilian government owns 29% of the stock. This company is a legal monopoly, so it's really important that this company operates so the whole entire country of Brazil can operate, because they supply more than 90% of the oil and gas to that country. The second biggest shareholder is the Brazilian Development Bank. They own 8%, then Capital Research, BlackRock, and Vanguard. Look at these price multiples. It's just unbelievable. That's why I was saying earlier, if this was a US company, their market cap would be north of $200 billion. A 2.4 PE. That's just unreal. I cannot even remember the last time I saw a PE this good. PE is stock price over earnings per share, or market cap over net income. So if we cut the net income in half, by cutting the EPS in half, that's the same as cutting the net income in half. We would still have a PE of 5, which is still amazing. Their price of sales is below 1. That means their revenue is higher than their market cap. Price to book of 0.9. That means the company is worth more in bankruptcy than active. If they liquidated all their assets and paid off all their debt, they can give each shareholder $10.41, even though each share is trading at $9.72. And almost all their assets are tangible assets. Even though I gave them a high whack of 14.5%, their ROIC is higher than that, almost 19%. Just amazing. They can cover their interest payments 5 times. They have an amazing ROE at 38%. Their current ratio is above 1. Their quick ratio is slightly below 1. They have $11 billion of cash on their balance sheet, $500 million of marketable securities, almost $5 billion of accounts receivables, $7 billion of inventory, and about $4 billion of assets held for sale. These are assets that will be sold within the next 12 months. They're not being used and not being depreciated. And this company is really well capitalized. They had $30 billion of free cash flow in the trailing 12 months. $5 billion of working capital, and they paid out $4 billion of dividend payments, so they have almost $31 billion of funding. The best way to look at ratios to compare them to companies in the same industry, I've done videos of 10 companies in the same industry as PBR, and if PBR has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So their price multiples are amazing, so much better than the average. Their current ratio is average. Their ROE is much higher than average. It's the highest on this list. They're higher in debt than the average company, and it's amazing they're not the biggest company on this list. They're smaller than the average company, and they pay the highest dividend. So to summarize, I have them trading at a 48% discount, and oil and gas companies have been putting up amazing numbers. But this company may be doing the best. Of course, investors are concerned with investing in a company in Brazil. There is a bit of geopolitical risk when investing in a developing country. But it seems like a great deal with how low the stock price is relative to their cash flows and revenue. It seems like a steal. I rank their free cash flows 10 out of 10, their revenue 9 out of 10, and their ratio is 10 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.